Today we delve into the distinction between cross-securitization and standalone mortgages. Cross-collateralization, also known as cross-securitization, is a loan structure where a loan or loans is secured by two or more properties. This approach allows borrowers to finance the entire purchase price of a property, including associated costs. Imagine for a second you're interested in buying an investment property worth $500,000. Luckily, you already own a home outright valued at $1 million. If you didn't own a property, you'd typically need to provide a 20% deposit plus additional fees such as stamp duty. However, because you own your own home, by cross-collateralization, you can borrow the purchase price plus the additional costs. This means you could borrow, say, $525,000 to cover all the associated costs, including the purchase price. This loan would be secured by both the property you intend to purchase and the home you own. To qualify for this type of loan, you would need to meet certain criteria and requirements. The bank typically will conduct a valuation on both your home and the investment property. The amount of equity you have in your existing property will determine if you're eligible for this loan setup. So in this example, we have two properties valued at $1.5 million in total. The first property is the investment property, and we're acquiring that for $500,000. The second is our home, and we know this is valued at $1 million. Through cross-collateralization, the bank holds a combined value of $1.5 million in properties. And in this scenario, we're borrowing $525,000. It would mean that the loan-to-value ratio would be 35%. Later in this video, I'm going to uncover the issues with this loan structure, so be sure to stick around. A standalone security refers to a loan or loans being secured by only one property. It's an approach that allows you to use a single property as collateral for a loan and can be beneficial if you're looking to build your property portfolio with inbuilt risk mitigation. More about this later in the video. Unlike cross-collateralization, where loans are secured by multiple properties, standalone securities focus on securing loans with a single property. Let's use a previous example to illustrate this. In this scenario, we would instead have two loans. The first loan would be $400,000 secured against the investment property we're buying for $500,000. This loan represents 80% of the value of the property we're purchasing, and by doing so, it allows us to avoid paying lender's mortgage insurance. The second loan would be $125,000 and would be secured by your home. As before, we would be borrowing a total of $525,000, but instead of one big loan secured by two properties, you would have two loans secured by each property separately, therefore allowing you to use two different banks if you so desire. At this point, one of the questions you'll have is what happens when you sell a home? Well, one approach allows you to sell a home smoothly without any added concern of the bank revaluing your properties. This means you can confidently proceed knowing how much you'll be left over once you sell your home. However, the other doesn't provide this as an advantage and might mean you'll be left with less than you had counted on. Let's delve deeper and look at the two approaches, how they work, so you can gain a better understanding of their future implications. With a standalone application, you have a clear understanding of the exact amount you'll be left over once the debts are paid off. This is because a standalone application consolidates all the loans attached to a single property, ensuring that when these loans are paid out, the remaining funds belong to you. On the other hand, a cross-secured application involves multiple properties, and in this case, the bank will need to conduct a revaluation on the remaining properties to ensure that the bank's lending margins are adequately maintained after the sale. It might mean that the bank will reassess the value of your properties involved to determine if they still provide sufficient security for the loans remaining. Because of this, you might be left with less money after the sale of your home. Many investors opt to secure their loans as standalone. One key advantage of this approach is the opportunity to collaborate with many lenders instead of being dependent on a single provider, allowing diversity and distributing the risk across different financial institutions. In a situation where a loan default occurs, the lender usually tries to regain the money by possessing and selling the properties tied to the loan. With each loan being independent in a standalone structure, the risk is contained to a specific property linked to that loan. Hence, you won't be forced to liquidate other properties to compensate for a default loan. However, it's critical to bear in mind that lenders have an all monies clause. Even though you may have an ideal structure, this clause permits the banks to take possession of any collateral held by the lender if a loan defaults. It means that you might have two loans with two different banks, but if both banks are owned by the same group, then it falls under this clause. Therefore, if you are seeking to further diminish your risk, it's a critical factor to consider, and a great mortgage broker can assist you in understanding this much better and setting your loans up correctly. And if you are looking for a great mortgage broker, Hunter Galloway is at your service. We operate across Australia and provide our service without any fees. Get in touch with us by our website at huntergalloway.com.au, or feel free to give us a call on 1300 088 065. Cross-securitization often simplifies your finances by granting access to equity without needing an extra home loan account. Additionally, it may lead to lower interest rates due to the overall loan-to-value ratio being much lower. On the other hand, standalone applications allow you to have a clear understanding what you're left with when you eventually do sell. For investors, this option often comes with an inherent risk mitigation function, making it a favorable choice. It's worth noting that there's no definitive right or wrong choice, and ultimately the structure should align to your long-term goals and should be based on what makes the most sense for your unique financial circumstances.